Hello and welcome back to the YouTube channel. Today we had a classic internal to external move. So I want to walk you through what I saw, and really once you guys see it, you're going to be like, oh my God, how could I have missed that trade? Because it was very easy to identify. Okay. So the key to the puzzle is the 1 minute the 1 hour FEG being tagged. Okay. So we have a 1 hour FEG that's left behind here. And right above it, we have London low. So on a 1 hour time frame, we're waiting for this market to come down into London low, tag it, also tag this 1 hour FEG. Classic internal to external move. Okay, that's how the market moves. And in this example, we're moving from London low to London high. Very simple. Okay, once we get that little sweep into there, I'm starting to get interested in a trade setup on the lower time frame. Okay, let's take price back and let's look at what happened. So market sweeps into here. This is the gap, the 1 hour gap. London low gets swept, 1 hour gap. We're now looking for a V-shaped recovery out of here. Boom, massive V-shaped recovery out. And you're probably thinking, well, Paul, how the heck did you trade this? Because the inverted fair value gap is long gone. Which is 100% accurate. Both 1 minute FEGs get inverted with literally no opportunity to take a long. Okay? The only way that you're getting in this trade is if you front run the gap. That's it, right? Well, no, there's actually still an opportunity to take this trade. And the reason being is the London high is left untagged. Okay? London high is left untagged. So, because of that, we're still able to find a trade setup into London high. Now, for example, let's say that this came down here, V-shape recovered, took London high. Boom, I'm done. I no trade, right? There's no trade setup. But because we failed to take it, I'm still very interested in the market drawing higher into London. This is why the draw on liquidity is so important. If a draw on liquidity is still open and viable and the market's showing me bullish order flow is now taken over, just because I missed the inversion doesn't mean I can't get creative to take a trade up into that draw. Okay? So here is the 1 minute FEG that it leaves behind. It leaves behind a 1 minute buy side inefficiency, sell side imbalance. Very strong, large gap. Okay? Now, all we had to do was wait for this market to come back into the gap, which is what I did. Stop below the 1 minute FEG. Target at London highs. Market comes back in, pulls in, boom. Right there, man. That wick right there is your entry. That's how fast you have to be and how accurate you have to be. That's the setup that I caught today. Barely any drawdown on it. Okay? Then the market goes straight to the London high. Boom. Done. Done and dusted. So if you look at this from a very simple internal to external move, you're going to be like, wow, that actually is very simple. And in reality, it is. When the market leaves behind a bullish FEG, and you have a liquidity pool, an overnight liquidity pool resting right above it, there's a very high likelihood the market's going to want to tag that pool, balance that PD array, and start to look for externals. Okay? Now, a lot of people in the comments last time say, well, that doesn't perfectly happen all the time. No, it doesn't. But when it does, you guys got to be able to identify it happening in real time. Okay, because if you don't have this knowledge and you don't have that 1 hour gap there, you don't have London low there, then you're really just trading blind. Okay? It's being successful trading is bringing everything together, right? It's bringing every part of the puzzle together, framing the setup, right? And if you guys don't have all those tools in your arsenal, then yeah, you're going to be taking trades that you're like, well, I don't really know if this makes sense, and you're not confident about it, right? This model gives you clear confidence, knowing that the market took internal, swept London, V-shape out, ripped higher, pulled back into a bullish FEG, and left behind a London high. Your eyes should have been lighting up like Christmas today, knowing that that London high was going to be a freebie to draw into. So to conclude in this video, don't overcomplicate things, but know the model that I'm teaching you guys here on the channel. The inverted fair value gap model works fantastic when it sweeps into a 1 hour gap, which also has a liquidity pool resting above it. In this case, we get both factors there, okay? And then we V-shape out, we retest a bullish gap, and we draw into our London high. So the inverted fair value gap model, guys, it's very simple. Don't overcomplicate it. Wait for your fair value gaps, or excuse me, wait for your liquidity to get swept. Wait for those higher time frame PD arrays to get filled, and then look for your models on the lower time frame. Okay? I hope you guys enjoyed this video today. It was a shorter video, but jam-packed with a lot of great content, I think. I hope you guys gain value out of this stuff. And what you could do for me, man, is like, subscribe, comment on the video to continue supporting this channel. And I'll see you guys in the next one.